Welcome to this video. Today we talk about cross-border trade, navigating the payment methods and procedures. There are various payment methods, procedures, risks, regulations involved in a cross-border trade. Especially trade finance for international trade is little complex, and the buyers and sellers, the exporters and importers have their own preferences and their own internal operation procedures which will decide the different payment option. What are the payment preferences? The exporter prefers cash in hand because it is most secure, because this method allows or ensures that the payment is received well before the shipment from the exporter's angle. The exporter also prefers a letter of credit because it is an assurance of payment. The bank guarantees that if the terms and conditions are met, if the documents are compliant, payment will be made on behalf of the importer irrespective of insolvency or bankruptcy of the buyer. The exporter will prefer documents against payment DP correction because the documents are sent to the presenting or collecting bank who will hand over the documents only against payment. The last option for the exporter could be an open account because this method is used for trusted customers and it involves shipment well in advance or well before the payment is being initiated by the buyer. Likewise, if we try to look at the transaction from a buyer's angle, they have their own preferences. The buyer prefers to have open account because the payment will be made later, it lowers the upfront costs and goods will be received well before the payment needs to be made. The importer prefers letter of credit because it assures that the payment will be made only if the exporter fulfills the terms and conditions and presents documents that comply with the expected specifications. The importer prefers a DA collection or a DP collection because he will have to accept or pay only against documents being received in his or her own bank. The necessary documents are presented, the list will also be provided evidencing the goods are moved out. The cash in advance the buyer feels is safe for the exporter and not for the importer. From the importer's angle, the buyer prefers direct payment because that will be made after the goods are shipped. In cash in advance, importer need to pay upfront and so their preference would be to avoid as much as possible. Then comes the trade credit. Importers may be able to defer the payment, allowing the time to sell the goods and raise funds. What does that mean? It means the seller will sell on 90 days from shipment basis or 90 days from delivery basis, and the buyer will have 90 days after the goods are delivered to pay, which means they will have enough time to sell these goods and raise the funds to settle the purchase dues. Now let us look at the events for each of the payment option. Now in cash in advance, importer places an order, exporter ships the goods, importer receives the goods and relevant documents. Under letter of credit, the importer and the exporter agree to the terms, the purchase order or a pro forma invoice or an underlying sales contract. We have something called CISG, International Sale of Goods Contract. Then we have the importer requesting an LC from their bank. The bank issues the LC to the exporter's bank, who advises the LC to the exporter, thereafter called as beneficiary. The exporter ships the goods and submits the documents to their bank. Exporter's bank forwards the documents to the importer's bank. Importer's bank verifies that the documents are in compliance with the terms and conditions. The documents are as expected, as specified in the LC, and then the exporter immediately receives the payment. That is, the bank honors against complying documents they are promised to pay. What is documents against payment? Documents against payment is exporter ships the goods and handles the shipping documents to their bank. Importer's bank, also called as collecting or presenting bank, presents the documents to the importer. Importer makes the payment and collects the documents and thereafter collects the goods. If it is DP. If it is DA, importer collects the documents against an undertaking to pay on due date, and on due date they will pay. The importer will pay. What is open account? In open account, exporter ships the goods. The importer receives the goods and pays at a later agreed date, which could be on delivery or 90 days from delivery, for example. What is consignment? Consignment is a type of trade where the exporter ships the goods with the undertaking that the payment will be made only after the goods are sold. Importer sells the goods and remits the payment to the exporter. In case the goods are not sold, goods are returned to the exporter. Let us understand the role of the parties and the terminology used with respect to, for example, letter of credit. Exporter is the party who is selling the goods or services. Importer is the party who buys the goods or services. Issuing bank is the bank that issues a letter of credit on behalf of the importer or buyer. Advising bank is the bank that advises the LC to the beneficiary or LC or the exporter. They just specify that the LC is complete, it is unaltered, it is genuine, etc. The advising bank is the beneficiary's bank or the exporter's bank. Confirming bank. A confirming bank is the bank that adds its own additional promise or a guarantee or an undertaking to an LC issued by another bank. This confirming bank, many times it is in the beneficiary's country, it can be in a third country also, it is outside the applicant bank country usually. The beneficiary or exporter is a party in whose favor the letter of credit is issued. Applicant or buyer is the party who requests the issuance of a letter of credit from a bank. And LC terms are the specific terms and conditions under which payment will be made, and it includes the maximum amount, the currency, the date by which shipment has to be made, the date by which documents has to be submitted, when the LC will expire, etc. Now let us describe some of the other methods of payment other than LC or collections. Factoring. In factoring, the seller sells the accounts receivable to the factor or a financial institution most of the time. Why do we say sells? Because that is a without recourse transaction most of the time. The factor or the agency who buys, the financial institution who buys the receivables or the invoices, gives a percentage of the invoice value and assumes the risk of non-payment. Gives a percentage means maybe 80, 90, 95, whatever, and assumes the risk of non-payment by the buyer. The seller receives immediate cash, he gets 90 or 95% immediately, and the factor collects the payment from the buyer at a later date. The documents required could be invoices, accepted invoice, which is a proof of sale and a proof of movement of goods in the form of a BL or a delivery note. Now, what is forfeiting? It is similar to factoring and mostly done on international transactions where the exporter sells a long-term receivable to a forfeiter, for example 180 days, 360 days or beyond that. The forfeiter assumes the risk of non-payment by the buyer, that is a risk of payment default, and provides the exporter with the immediate funds. The seller gets the funds immediately and the buyer will pay on pre-agreed due date, which could be 360 day or more. Documents required are again export documents like export invoice or bill of lading or other evidence of having performed their leg of the transaction. Now let us describe the procedure used in various instruments in case of a default. Now, letter of credit. If there is a default, the exporter can present the required documents to the bank and receive the payment, which means the seller will present the documents to the seller's bank or nominated bank, or the seller will present the documents to the confirming bank, or the seller can present the documents to the issuing bank, and then they will get the payment. As long as the documents are compliant, they will get the payment. They will receive the payment against documents that evidence having met the terms and conditions specified in the LC. What is documents against payment? If the importer defaults, that is, importer doesn't pay, then the bank holding the document will not release the documents until the payment is made in a DP. In a DA, the documents are mostly released against a trust receipt. In factoring or forfeiting, the product is such that if the importer defaults, the factor or forfeiter will have to assume the loss, because most of the time it is without recourse unless it is some fraud or some collusion that has been identified. Now let us identify some of the risks. Now talking about risk, most important risk is the credit risk. The risk that the importer or the buyer will default on paying on due date. This can be reduced by using letter of credit or factoring or forfeiting because the risk passes on to the bank. Currency risk. It is an exchange rate fluctuation risk. Now sellers and buyers may use forward contract or hedging tools to mitigate this risk, options, futures, etc. Now, if you have transaction in various countries and if you are buying and selling from various countries, because you have payments in foreign currency and receipts in foreign currency, it could be a natural hedge. Then comes the political risk. The risk of changes in the political condition, changes in the legislation, changes in the regulation, changes in the tariff, changes in the quotas, changes in the way the government provides subsidies or encouragement or discouragement to a particular goods or a sector. This can be managed by standby LCs or guarantees to a certain extent, and more by export credit agencies or the Exim Bank cover. Liquidity risk. The risk of needing immediate cash. For this, factoring and forfeiting are the best methods. Otherwise, we may have to seek buyer's credit where the payment terms will be 90 days from invoice or 180 days from shipment, etc. Operational risk. This is very difficult because the documents or the terms and conditions might not, the party will not be able to meet the terms and conditions, or the documents may have discrepancies or errors, and this causes a risk of non-payment or delays in the payment. For this, letters of credit can be structured in such a fashion to minimize these risks, and the document preparation can be strengthened to minimize the discrepancies. Now, differences between documentary credit and other trade payments also we have to look at. In documentary credit, the bank is giving a promise or a guarantee that they will pay. In other solutions, for example, an open account, there is no promise by the bank. We are dependent upon the buyers or the sellers' performance risk and payment risk. While in factoring and forfeiting, the institution buys the receivables, and so the transaction is off the books of the party. What are the benefits and risks of guarantees? In case of a bank guarantee, the assurance from the bank is a benefit. The risk is it is costly. In case of bonds, it is similar to the guarantee issued in certain geographies by certain institutions. Could be from the corporates also. As far as the standby letters of credit concerned, it is similar to the guarantee. It gives a security of payment by an institution. The risk is it is complex and it may seek lots of legal fees and other costs. Let us also look at the sequence of steps in the issuance of an LC or a guarantee. First, the buyer and seller agree on the terms of contract. Then usually the buyer requests for issuance of a credit from the issuing bank, while in case of guarantee, the seller requests for a guarantee. The issuing bank sends the letter of credit to the advising bank, that is a buyer's bank, and the buyer's bank sends it to the buyer. In case of a guarantee, the seller requests for the guarantee is given to the seller goes and submits a guarantee to the buyer of the services. In case of a normal trade, exporter ships the goods and provides the documents to their bank sends the documents to the buyer's bank verifies the documents, finds them to be compliant, and then they will pay. Thereafter, they will pass on the documents to the buyer and seek payment from them or reimbursement. In case of a guarantee, mostly there will be no claim, but in case things go wrong, then the buyer's bank will receive the claim from the buyer, which will be passed on to the seller's bank to be paid under the guarantee. The issuing bank normally has up to 5 working days after the receipt of documents for examination of the documents whether they are compliant or not. Now, there are certain benefits and risks in using the guarantee or the bond or a standby LC, which you have already seen. So, the risk reward ratio or the cost benefit analysis will be undertaken by both the parties. Now, the rules and regulations come from the international conventions. Now, United Nations has certain conventions, then International Chamber of Commerce has certain rules. The ICC has given a uniform customs and practices for documentary credit, UCPDC 600 for the LCs. We have International Standby Practices, ISP 98 for the standbys. We have URDG, Uniform Rules for Demand Guarantee for the guarantees. We have URC, Uniform Rules for Collection for the DADP collections. Then we have the United Nations Convention on Contracts for International Sale of Goods, CISG, Contract for International Sale of Goods. Then we have an International Factors Group, IFG, which gives the rules for factoring forfeiting operations. Then these are the various rules or the regulations or the guidances that are available for conducting international trade. Thanks for watching this video. We were talking about how we can navigate the cross-border trade with respect to the products, the payment methods, the risks and the instruments. Thank you.